Welcome back to the Deep Dive. Today we are opening some files that have been kept quiet for a very, very long time. We believe we're looking at the single greatest strategic financial play of the last 2 decades.
It really is. We're talking about a geopolitical adversary methodically executing this patient, massive, and almost perfectly hidden accumulation of a vital industrial metal.
And it's designed ultimately to do one thing: neutralize the core strength of the U.S. economy.
I'd say it's even more than just a financial move. This
No.
is long-term strategic weapon deployment. We've been tracking forensic trade data, global inventory reports, official consumption figures.
All the boring stuff that tells the real story.
Exactly. And when you connect all those dots, across 20 years of this quiet activity, the magnitude of what you find is, well, it's genuinely staggering.
So what are we looking for?
We are searching for millions, maybe even billions of ounces of physical silver that have they've effectively vanished from every public ledger and global supply chain.
Vanished. Like a ghost. We often track the big news, the drama, the quarterly earnings, the visible shifts in geopolitical power. But today, we're looking in the secret files. We're looking at the quiet, multi-decade moves that set the stage for currency wars years or even decades down the line.
That's it. This isn't just a story about high demand. It's about an intentional, systematic accumulation.
A plan.
A very detailed plan. Our source material today details what analysts are now starting to call the silver gambit. It's a multi-decade planned strategic move to acquire what you could call the ultimate silver bullet.
And today we're analyzing the mechanics of that. How is this hoard built? How does it interact with the what looks like a collapsing Western paper system, the London silver pool crisis?
And we'll get into the alarm bells, the ones that major CEOs, notably in the defense and automotive sectors, are ringing all over the world right now.
So our mission today is crystal clear. We need to understand the mechanism. How does a massive hidden stockpile of metal become the ultimate weapon, the silver bullet, aimed directly at paralyzing the U.S. industrial base and challenging the global dominance of the U.S. dollar?
And for you, the listener, the central mystery remains. How hard is it really to hide thousands and thousands of tons of metal? It seems impossible.
Right. And why would they keep this weapon completely secret for so long if they weren't planning on a truly impactful deployment, a deployment that, threatens the entire Western financial structure? Okay, so let's unpack this mystery first. You said it's not just high market demand, it's an accounting gap, a gap so massive it sort of defies normal explanation. So detail the forensic evidence for us. What is this ghost silver discrepancy that tipped the analysts off?
Well, the beauty of it, or maybe the terror of the discovery, lies in how simple the math actually is.
That's usually how it works.
It is. We use the most basic accounting principle you can imagine. The formula is just this. You take the total annual global supply.
Okay, and what does that consist of?
It's made up of 3 things. First, mine production, what's dug out of the ground. Second, scrap recycling, so old jewelry, electronics, that kind of thing. And third, any imports into the country.
Got it. So production plus recycling plus imports, that's the total supply for a given year.
That's everything that's available. Then you just subtract the documented industrial use.
So how much the solar industry used, electronics, medical, all that stuff.
Exactly. You look at how much those industries reported consuming domestically, it's all on the books.
And when you run that math for the whole world, the result should be what? It should balance out, more or less.
It should. The result should either be a small deficit, which gets filled by drawing down visible inventory from exchanges like COMEX or the LBMA in London, or a small surplus, which adds to those inventories.
The numbers should line up.
Precisely. But when you apply this exact formula, this simple math, specifically to the flow data related to one major geopolitical player, China, and you do it over the last 20 years, the result is an enormous and systematic structural discrepancy.
That doesn't balance.
It doesn't even come close. Millions upon millions of ounces of silver have entered the country. They were refined domestically, but they were never exported, and they were never officially accounted for in any public consumption reports.
So this silver, it didn't just disappear into jewelry or electronics that someone forgot to log.
No, it has effectively vanished inside the country's borders.
So we're not talking about a rounding error in a spreadsheet?
Not at all. This is a cumulative, systematic deficit in the public record that strongly implies the existence of an intentional, massive shadow reserve.
Let's pause on that word, hidden. If analysts can calculate this 20-year deficit, how secret can this accumulation really be? I mean, are we suggesting that Western intelligence agencies have just been ignoring the math for 2 decades?
That's a really critical point. It's hidden not from the analysts who study the commodity flow data, but it's hidden from the public eye and, most importantly, from official reserves reporting. And that's where transparency is expected.
Ah, so it's not on their official balance sheet.
Exactly. They haven't reported it as part of their national bullion stock, which keeps the total amount off balance sheet from a geopolitical perspective. It's a strategic asset they don't have to declare.
And the scale.
The scale of the disappearance, which some analysts estimate in the hundreds of millions of ounces, possibly more, suggests this shadow reserve has been designed specifically to rival or maybe even exceed their official gold hoards.
It's simply too big to be an accident.
It's too large, too persistent over 20 years, and frankly too valuable to be accidental industrial hoarding. This is a strategic national asset being acquired and stored with extreme discretion.
That longevity, the 20-year accumulation, that's what's so fascinating. This isn't some panic buy that happened last year during a supply chain crisis. There has to be a cultural or historical context that explains this patience, this focus on silver specifically.
To understand the patience, you really have to look back to the early 20th century. Most people don't realize that China operated on a silver standard all the way until the 1930s.
So it's in their monetary DNA.
It is. They understand silver's historical and cultural role as true money, as a physical representation of wealth, far better than the modern West does. We've almost entirely relegated it to being just an industrial commodity.
Just another input for a factory.
Right. But they see it differently. That deep-seated, multi-generational viewpoint informs their long-term strategy. They view silver as strategic collateral, not just feedstock for solar panels.
And what were the specific strategic moves they started making back in the early 2000s? Right at the time when the West was doing the exact opposite.
It was a perfect strategic countermove. It was brilliant, really. While Western governments, and the U.S. specifically, were liquidating their entire strategic silver stockpiles in the 1990s and early 2000s.
Often explicitly to keep prices down.
Yes, explicitly to suppress prices and remove pressure from fiat currencies. While that was happening, China was quietly executing the opposite strategy. They were buying the dip and securing resource control for the long term.
So they were encouraging their own citizens to buy silver, diverting supply that way.
They were. But the most powerful move, the real checkmate move, was controlling the resource flow itself.
And that's the ban on the export of silver ore. Tell us the mechanics of that. How did that ban let them hoard so much, so quietly?
Precisely. So, historically, if you dug silver ore out of the ground in China, you'd send it to a refinery in London or New York for processing.
The global standard.
Right. But they banned that. They said if the ore comes out of Chinese ground, you are now forced to refine it domestically. Now, this action was implemented under the guise of, environmental protection or resource management.
Plausible deniability.
Of course. But it gave them two crucial things. First, it gave them unprecedented visibility into the actual physical flow of metal within their own borders. They knew exactly how much was being produced.
And second,
and this is the most important part, it gave them much greater control over where the finished refined silver bars ultimately went. Instead of that new metal being obligated to Western consumption channels, it could be easily and quietly redirected into this growing, non-reported shadow reserve.
that is such a profound distinction. It's a perfect piece of geopolitical positioning. While the U.S. was financializing its economy, just massively expanding debt and printing paper claims on everything, China was physicalizing its economy.
Stacking atoms, not IOUs.
Stacking atoms. It's a geopolitical setup for a currency war, where one side has hard strategic assets and the other side has promises and a dismantled industrial shield.
It sets the stage for a checkmate. And they're using an asset that the West not only intentionally liquidated but systematically suppressed the price of for 2 decades because they believed it was just a commodity.
They weren't just accumulating gold, which everyone expects.
No. They were accumulating the one critical industrial metal that allows the West's advanced economies to even function, the one thing we can't do without.
Okay, so we've established the accumulation mechanism, this 20-year vanishing act. Now, let's connect this stockpile to the central question. How exactly does a secret hoard of metal become a weapon aimed at U.S. industrial capacity? Why is silver a more effective weapon to kill a dollar than, say, gold?
The distinction really lies in its utility. It's a simple but powerful difference. Gold is, for all intents and purposes, purely monetary.
A store of value.
A store of value, a central bank asset. If China were to dump all its gold tomorrow, yeah, the dollar's value might fall, trust in the currency might erode. But, and this is the critical part, U.S. factories would keep running. The lights would stay on.
But silver is different.
Silver is a dual-use weapon. That's the key concept. It is both historical money and an absolutely critical, irreplaceable industrial material. So if China targets the silver supply, they achieve two goals at once.
What are they?
One, they inflict massive inflationary pressure on the dollar, and two, they directly paralyze American industry.
That industrial paralysis is the key. That's the bullet. So give us specific, detailed examples of where silver is so critical that a supply shock becomes an existential threat to the U.S. We need to understand the structural dependency here.
Let's start with the absolute non-negotiables. First up, U.S. defense and aerospace.
The military.
Yes. Silver's incredibly high electrical and thermal conductivity makes it essential for advanced military technology. We're talking about proximity sensors, missile guidance systems, high-frequency communications gear.
The really high-tech stuff.
All the next-generation defense platforms. If you cannot get silver paste, you cannot reliably produce advanced missiles or stealth components, full stop.
Okay, so that's defense. What's next?
Second, U.S. energy infrastructure. Silver is vital for solar photovoltaic cells. The solar industry is what we classify as an inelastic buyer.
Meaning they have to buy it no matter the price.
No matter the price. They have massive government mandates to fill, often under very tight timelines. They can't just halt production because the price of silver went from $25 to $100. They have to buy it to meet their targets. That demand curve is completely non-negotiable.
And the third leg of the stool.
Yeah.
The modern consumer economy, Silicon Valley and electric vehicles.
Absolutely. Silver is used in microprocessors and specialty chips, especially in the high-reliability chips required for things like autonomous driving and sensitive medical devices, but more importantly for the EV market.
The batteries.
The connectors. It's used in high-voltage connectors and bus bars within the battery systems. These components have to handle immense current flow, and conductivity and longevity are paramount. If the silver supply stops, advanced manufacturing in EVs stops cold.
So hitting the silver supply isn't just a broad monetary hit. It's a surgical strike on the entire high-tech U.S. industrial base.
It's incredibly precise.
Now let's talk about the Achilles heel. The U.S. vulnerability that makes this whole gambit so effective.
Yeah.
And it's a vulnerability we created ourselves by our own policy.
The Achilles heel is our intentional, complete lack of preparation. It's almost unbelievable. The U.S. has zero strategic reserves of silver.
Zero.
Zero. Our government had maintained strategic stockpiles since World War II for exactly these kinds of emergencies. But in the 1990s and early 2000s, the U.S. government sold off the entire strategic stockpile, every last ounce.
Why? What was the thinking there?
The prevailing economic theory at the time argued that these stockpiles were unnecessary, that the free market would always provide. And, of course, that their liquidation could help suppress the commodity price. A classic political move to fight the appearance of inflation.
So we took our national industrial insurance policy and we cashed it in for a temporary price dip. That sounds like a profoundly short-termist decision.
It was catastrophically short-sighted from a strategic perspective. We have no buffer, and you couple that with the standard U.S. industrial model.
Just in time.
Exactly, just in time, or JIT manufacturing. It's incredibly efficient, but it relies on a continuous, uninterrupted flow of materials. Most of these critical factories maintain only a few weeks of inventory on hand.
So what does the source material warn about that?
It warns that if the silver flow stops, if China simply halts exports tomorrow for just 30 days, critical defense contractors, EV factories, and solar manufacturers would suffer mandatory production halts.
30 days. That's it.
That's the window.
That's where the analogy really hits home. It feels like China is holding the oxygen tank for our entire advanced manufacturing sector, and they can just pinch the tube whenever they want.
They can. The industrial base suddenly becomes fragile, and that fragility is transferred directly to the U.S. dollar's stability. If our economic output grinds to a halt, the faith in our currency evaporates almost overnight.
And this raises the ultimate question of the currency war, doesn't it? What actually backs a currency?
It creates a massive perception shift. The ultimate threat here is that the yuan could be marketed globally as a currency backed by the stuff you need to build the future. The physical collateral of industrial strength.
Well, the dollar is backed only by
faith and credit. When one side has the actual atoms necessary for production and the other side only has debt, the long-term confidence equation changes completely. This makes that hidden hoard a weapon of financial and industrial mass destruction.
Okay, it sounds like the Western financial system has been trying desperately to manage the price of silver to prevent this exact supply crisis from blowing up. They've been fighting reality for years.
They have.
So let's talk about that management, specifically the collapse of the paper system, what the sources call the London Silver Pool. To understand the present danger, you're saying we have to look at a direct historical parallel from 1968.
We do. History really doesn't repeat itself, but it certainly rhymes in these deep dives, and this is a powerful rhyme. In 1968, we witnessed the collapse of the London Gold Pool.
And this was an official group.
It was a formal, coordinated entity of 8 major central banks: the U.S. Federal Reserve, the Bank of England, the central banks of Germany, France, Italy, the big players. And they were all trying desperately to fix the price of gold at $35 per ounce.
And their mechanism for price fixing was simple, right? Whenever demand for physical gold spiked, they would just sell their own reserves into the market.
That was the plan. They'd collectively sell their physical gold to suppress the price and restore faith in the dollar's peg.
But it didn't work.
No, the demand completely overwhelmed them. By March of 1968, they had run out of physical gold to sell. France had already pulled out, seeing the inevitable collapse, and the remaining banks realized the game was over.
So the pool collapsed.
It collapsed, and the price instantly exploded the moment that artificial supply vanished. It was the event that forced the abandonment of the $35 gold peg.
So now introduce the modern parallel, the unofficial London Silver Pool.
The modern silver pool operates on the exact same principle, but it's unofficial. It's centered around the LBMA, the London Bullion Market Association, and it includes major bullion banks like JP Morgan and HSBC.
But the goal is the same.
The goal is identical. Use paper mechanisms to create the illusion of an infinite supply, suppress the physical price, and maintain confidence in the fiat currency system. They use paper leverage to crush any rally that's spurred by real, physical industrial demand.
Okay, so how do they do that? How do they create that phantom supply need to suppress the price, especially when the banks don't physically have enough metal to cover all their claims?
They rely on fractional reserve banking, but they apply it to metal. And they do it primarily through something called unallocated accounts.
This is a critical concept for our listeners to understand.
It's everything. When you buy silver in London through an unallocated account, you don't receive ownership of a specific numbered bar in a vault. That would be an allocated bar.
So what do you get?
You get a credit, a line item on the bank's balance sheet. The bank owes you the metal, but they have the right to hold the physical collateral. You're an unsecured creditor.
So this is like a bank selling 10 reservations for one actual hotel room.
That's the perfect analogy. This system allows the banks to sell claims on the same single bar of silver to multiple investors, 10, 20, sometimes 100 times over.
And that leverage is what creates the illusion of abundance.
The phantom supply. It artificially keeps the spot price low. This leveraging is the core mechanism through which the price suppression has worked for decades.
And they use this phantom supply in a mechanism called leasing. How does the hidden hand use leasing to smash price rallies?
Okay, so let's say physical demand rises. The global solar industry suddenly needs massive amounts of silver. The price should jump, right?
Right.
Well, the pool steps in. A central bank or a major vault holder might lend physical silver to a bullion bank. Now, the central bank keeps the leased metal on its books as an asset, even though it's physically gone and being sold into the market.
So it's still on their balance sheet, but not in their vault.
Exactly. The bullion bank takes that leased metal, sells it to crush the rally, and in doing so creates a massive commercial short position. This hidden hand operation has successfully prevented silver from breaking key psychological price barriers for years, keeping it artificially cheap for industrial buyers in the West.
But the game only works as long as there is physical metal left to lease and sell.
That's the catch.
And this is where we hit the hard reality that defies all the paper schemes. The 2026 deadline. And this isn't a speculative date. It's a mathematical limit based on the burn rate.
That's the physics of the system winning over the financial theory. It's inevitable. Analysts track the inventory levels in the LBMA vaults and the rate of drain. Since 2021, those vaults have been depleting steadily.
And where's it going?
Massive amounts of silver are leaving London and heading east primarily to meet the industrial demand from India and China. But the key isn't the headline inventory number, it's the effective float.
The amount of silver that's actually available for the pool to use.
Right. The LBMA reports these big headline inventory numbers, but most of that silver is already owned by private funds or ETFs. It's allocated. It's essentially locked down and can't be used for this fractional selling.
So the usable inventory is much smaller.
It's a tiny fraction of the headline number.
Yep.
And the drain rate on that tiny fraction is currently calculated at about 100 to 150 million ounces of physical metal leaving the system every single year.
That's a huge number.
It's relentless. And based on this inelastic drain, analysts predict the free float. That usable supply the banks can tap for leasing will hit zero effective float sometime in 2026.
Zero. And what is the immediate non-negotiable consequence when that float hits zero?
The leasing mechanism stops. Immediately, the manipulation stops. The paper pool runs completely dry because they literally have nothing left to sell or borrow.
So just like the gold pool in 1968.
Exactly like 1968. The market will be forced into true violent price discovery. All those massive commercial short positions the banks hold, the core of the hidden hand, will be forced to cover, leading to a massive sudden price reset. This is the collision of the paper schemes with physical reality.
So the countdown to 2026 is based on the math, on the drain rate. But we're also seeing panic from the biggest industrial players, which seems to confirm that the scarcity isn't just theoretical anymore. It's structural and it's immediate.
It is.
So let's talk about the Elon signal. Highlight the profound importance of Elon Musk's three-word response to China's export restrictions.
Musk's reaction was a profound moment of insider panic that really confirmed the entire investment thesis for a lot of people. When the news broke that China was potentially restricting silver exports, which, ties directly into that resource control we discussed.
Right back to part one.
Exactly. His three-word response on social media was stark and unambiguous. This is not good.
That is not the language of a CEO who has some easy secret silver replacement ready to go.
Not at all.
Or someone who believes the problem is just temporary. If he had a copper-based solution ready to scale up, he would have just shrugged it off.
Yeah.
Wouldn't have even cheered the news, right? He would lower his input costs and crush his competitors.
He would have. But no, his concern validates the whole thesis. The shortage is not only real, but it is geopolitical. And it directly threatens the high-volume, high-reliability production goals of companies like Tesla, which spans both solar and high-end automotive manufacturing.
So his warning is basically a distress signal.
It is. He's informing his procurement teams and the market that these supply chains are now critical. And what we're likely witnessing now is the beginning of a quiet, desperate corporate hoarding campaign, driving inventories even lower in response to this looming threat.
This brings us to that fundamental conflict you mentioned. Physics versus hope. Western manufacturers are hoping R&D can save them, that they can substitute silver out. But why can't technology save the West in time? What is this failed copper replacement theory up against?
It comes down to the immutable laws of physics, specifically oxidation and performance degradation. Rust, basically. Copper is highly conductive, yes, but when you expose it to air and moisture, which happens in a solar panel sitting outside for 20 years, or in the harsh underbelly of an electric vehicle, it rusts and oxidizes very rapidly.
But silver doesn't.
Silver is unique. It is the most conductive metal, and it's highly resistant to oxidation. So if Tesla were to use a cheaper alternative, like a copper-based conductive paste in its solar panels or EV connectors, the conductivity would just drop over time.
The performance would degrade.
Exactly. The connection would degrade quickly, potentially leading to system failures, loss of efficiency, and critically for a company like Tesla, a huge spike in warranty costs.
Right. They can't afford to sell millions of cars that might have system degradation or fire risks in just 3 years.
They absolutely cannot. Solving the oxidation problem at scale and ensuring reliability across all climates and all conditions is an R&D challenge that takes years and billions of dollars to solve perfectly. Musk's panic confirms that silver is still the Tier 1 requirement for performance, reliability, and longevity in these critical applications. Physics has no negotiation strategy.
And even if they do manage to thrift some silver usage, say, through minor innovations, they become 50% more efficient per car. We run headlong into the Jevons paradox.
We do.
Explain why efficiency in usage actually acts as a catalyst for draining the vault even faster.
The Jevons paradox, it's named after a 19th century economist, and it states that increasing the efficiency with which a resource is used tends to increase, rather than decrease, the rate of consumption of that resource.
Which sounds completely counterintuitive.
It does, but it makes sense when you think about it. Why? Because the increased efficiency lowers the marginal cost of production. It makes previously impossible scales of production suddenly viable and profitable.
So let's apply that directly to the Tesla scenario.
Okay, so Musk's plan is to scale Tesla's volume from around 2 million cars a year to, let's say, 20 million cars a year, a 10x
A
increase.
huge jump.
A huge jump. Now, even if his engineers are brilliant and they cut the silver usage per car by half a 50% efficiency gain, his ability to ramp up production so dramatically means that his total aggregate demand for silver doesn't fall. It rockets up by 500% overall.
So the efficiency gain just unlocked the massive scale.
Precisely. Efficiency accelerates depletion, it enables scale, and that scale is what's draining the London and COMEX vaults faster than any retail speculator ever could. The industrial bid is not speculative, it's mandated.
And this is the critical insight, isn't it?
Yeah, it is. Industrial demand is inelastic, and it's overwhelming. They must have the metal to build the future, to meet government mandates, and to produce their product pipeline. This massive inelastic industrial demand is the catalyst that will ultimately collide with that zero effective float in 2026 and break the paper pool.
So the final takeaway from Musk's warning is the acceleration of corporate hoarding. If the biggest buyer in the world is publicly worried, you could bet other large industrial players, solar giants, defense contractors, semiconductor firms, are quietly doing the exact same thing right now.
Absolutely. They realize they cannot afford a 30-day production halt. They are initiating corporate hedging strategies, securing multi-year offtake agreements directly with refiners, building up private vault relationships outside the COMEX system, and increasing their inventory levels from weeks to months.
So this quiet scramble for physical metal just accelerates the drain rate.
It does. It pulls that 2026 deadline even closer. The supply crisis has transitioned from being a financial theory to a hard industrial reality, and it's being driven by CEOs who are terrified of getting cut off.
All right, now we put all the pieces together. China has the secret stockpile, the ghost silver, waiting in the shadows. The West has zero strategic reserves and a collapsing paper inventory that cannot withstand this industrial drain rate. So how can China weaponize this hoard to execute the silver gambit? How do they achieve either industrial paralysis or currency checkmate?
They have two very clear deployment options, and both of them lead to pretty catastrophic outcomes for the dollar.
Okay, start with scenario A, the withholding. This is the direct kinetic supply shock aimed right at the industrial base.
This is the simpler, fast-acting option. It's the brute force approach. China declares its vast hidden stockpile, that shadow reserve we talked about, a strategic state asset.
And then what?
And then they completely halt exports of refined silver, citing national security or critical domestic consumption needs. Given China's massive role in global refining and mine production, the global supply instantly drops by 20%, maybe even more.
And Western economies, running on just-in-time inventory.
They face immediate panic bidding.
So what happens to the price and the economy, like, the next day?
The price would gap up dramatically. Analysts predict an instant spike to $100, maybe even $200 per ounce, as defense contractors and solar companies bid desperately against each other for whatever supply is left.
And the economic fallout.
This targeted supply chain failure triggers massive, targeted inflation in key sectors. It paralyzes high-tech manufacturing in the U.S., and it raises the cost of virtually every advanced electronic component. The economic damage would be immediate and systemic.
Okay, that's the sledgehammer. Now, scenario B, the backing. This is the elegant, long-term currency checkmate that hits the dollar's reserve status.
This is the ultimate move against the dollar's hegemony. China could announce a new asset-backed currency standard, and they might do it in coordination with the BRICS nations, who are already actively seeking alternatives to the dollar system.
And they wouldn't back it just with gold.
No. That's the key. They wouldn't back it just with their official gold, but with their massive, previously hidden silver and gold hoards. The announcement would be simple and powerful. 1 new yuan equals X grams of gold plus Y grams of silver.
The psychological warfare of that announcement alone would just be devastating.
It would be. It instantly exposes the US dollar as being backed by nothing but debt and a printing press. At the exact moment, an alternative emerges that offers physical, industrial collateral.
So global central banks, sovereign wealth funds.
Everyone. They would have a powerful incentive to begin dumping their holdings of U.S. treasuries and U.S. dollar cash for this new asset-backed yuan. This mass exodus causes the U.S. bond market to implode, forcing the Federal Reserve to print massive amounts of currency just to maintain basic market function.
Which triggers catastrophic hyperinflation in the United States.
Right. And this is where we trace the domino effect. The cascade starts with the physical reality of silver, but ends with the financial collapse of the dollar.
What's so fascinating here is the interconnectedness of the manipulation, how one lie supports another.
It's a house of cards. The first domino is the physical market. If the London silver pool breaks when it hits that 2026 deadline, it proves that the entire paper metal system is fraudulent, that it's leveraged far beyond its physical capacity.
And that failure of trust immediately spreads.
It evaporates confidence in the gold paper market as people realize their gold claims might also be fractional. And if trust in the gold market vanishes, then the underlying faith in the sovereign bond market, which is fundamentally backed only by the fiat currency printing press, that evaporates next.
The system is so leveraged, and the physical asset running dry is the one pin you pull that makes the whole thing collapse.
It is.
So let's bring this home. What does this all mean for the listener? What are the real-world consequences of this domino effect hitting Main Street?
The consequence is simple. It's the destruction of your purchasing power. If the dollar loses its reserve status and hyperinflation strikes, imported goods, and that's the vast majority of our electronics, gasoline, and increasingly, our processed food will double or triple in price in a very short amount of time.
And your savings.
Your dollar savings, the money in your checking account, your pension, your long-term CDs, they are effectively deleted in terms of what they can actually buy.
But if you hold physical metal...
If you hold physical metal, the very asset that China is weaponizing, it serves as your protection. The price of the metal isn't really going up. The value of the measuring stick, the dollar, is going down. The metal simply maintains your purchasing power through the crisis.
Stakes are. They're existential. If China executes this silver gambit, the dollar's reserve status is threatened. The domestic industrial base is paralyzed by scarcity. With American factories potentially closing in 30 days due to a lack of metal, what are the desperate options the U.S. government has to fight back?
This is the critical endgame discussion. When a financial hegemon is cornered, when it faces losing both its currency dominance and its industrial capacity, its options are limited, they're often severe, and they almost always involve internal controls.
Okay, let's start with the extreme measures on the global stage. What's the first option?
Option one is war. I mean, history suggests that a declining hegemon, when it's facing the imminent loss of financial and economic power, resorts to military power.
And what would that look like?
It could range from severe economic blockades against China, declaring their silver, withholding an act of financial aggression, to, outright kinetic conflict to force the flow of critical resources like silver back into U.S. supply lines. The U.S. military depends on that silver supply, making this a national defense imperative.
Okay, so that's the military option. What's option two? Remonetization. Trying to beat China at their own game by front-running their asset-backed move.
Exactly. They could try to restore global faith quickly by pegging the dollar to another asset. Whether that's gold, as some historical economists have suggested, or maybe a new politically controlled digital asset like a central bank digital currency that is somehow asset-backed.
The goal would be to restore trust.
To restore global trust in the dollar quickly, though the logistics and the political will for this in the middle of a resource crisis are highly, highly questionable.
But the most dramatic, and perhaps the most immediate option, given the industrial paralysis, is option three, confiscation. The government seizure of domestic silver.
This is the option that every retail physical holder must be aware of. The U.S. government could invoke the Defense Production Act, the DPA.
On what grounds?
Given that silver is classified as critical for advanced military technology missiles, radar, and essential infrastructure like the energy grid, they could easily deem the domestic silver supply a strategic necessity under the law.
And we have historical precedent for this, don't we? The 1933 gold confiscation comes to mind.
We do. In 1933, President Franklin D. Roosevelt issued Executive Order 6102, which effectively criminalized the private ownership of gold bullion by U.S. citizens. It forced them to sell their gold to the Federal Reserve for a fixed price.
And the rationale then was to end deflation and stabilize the banking system.
Right. But in a silver gambit scenario, the rationale would be national security and industrial survival. This could lead to the seizure of all domestic silver supplies, both industrial and potentially retail, and a ban on private ownership, forcing that metal into state hands to save critical supply chains.
But logistically, silver is everywhere. It's small, it's easily hidden, it's widely dispersed. How practical is it for the government to actually seize millions of ounces of retail metal across the country?
The logistics are incredibly difficult, I agree. But the government doesn't need to find every ounce. They only need to seize enough to break the domestic scarcity and keep the defense sector running for a few months.
So they would target the big players first.
They would likely target major smelters, mints, and large private vaulting operations first. The immediate move would be to ban retail sales and exports, making the metal flow only to authorized government contractors.
So the primary threat to the individual holder isn't someone knocking on your door.
No. The primary threat isn't physical removal by a federal agent. It's the government declaring your asset illegal to own and forcing you to sell it to them for a fixed low price in rapidly devaluing dollars.
That's why possession is so key. Which brings us to the smart money playbook for the listener. If this 2026 deadline is approaching and the threat of dollar collapse and potential confiscation is real, what should be done?
The playbook is defensive, and it focuses on owning the asset that is being cornered and weaponized. First, audit your financial position. Reduce your exposure to long-term U.S. treasuries, that is the asset China will be dumping in scenario B.
And second,
Buy the weapon. You must own the physical metal. When China pulls that trigger, the price of silver goes vertical, and you want to be on the long side of that massive re-rating event.
and the final most crucial step, especially given the leverage of the London pool, is understanding the risk of paper claims. You mentioned a margin hammer event before. Explain that and why physical custody is so essential.
We saw the margin hammer deployed by the CME Group during peak volatility. The exchange simply raised the margin, the collateral required to hold a paper futures contract, by 25% overnight.
Which forces anyone with a leveraged position to sell.
It forces leveraged paper shorts who cannot post the extra cash to sell their positions immediately or face massive losses. It's a mechanism to liquidate paper traders and reduce price volatility, and it proves that paper claims are volatile and subject to rule changes by the exchange.
And paper silver accounts, like those unallocated accounts in London.
They are the first casualties in a banking or currency crisis. Physical holders, people who hold the metal outside the banking system, are immune to those exchange rule changes and forced liquidations. If you don't hold it, you don't truly own it, especially when governments and banks are fighting for their own survival.
So to summarize the investigation, the hidden silver hoard is a verifiable fact, rooted in forensic accounting. The planning has been underway for 20 years. The vulnerability in the West's supply chain zero reserves, just-in-time inventory, makes this dual-use metal the true silver bullet.
And the timeline is set by physics and math. That 2026 deadline when the paper pool runs dry. The central conflict of this entire deep dive remains. The U.S. has debt and a printing press. China has factories and the physical collateral needed to run them. In an era of resource control, the choice for asset ownership is becoming very, very clear.
And that brings us to our final provocative question for you, the listener. If the U.S. government genuinely believes that China's secret silver stash threatens national security and its domestic industrial base, and if they feel they have exhausted all other options, how quickly might they justify declaring all domestic silver a strategic asset, invoking the same laws they used in 1933? Will you be ready to choose between the metal you hold in your hand and the rapidly devaluing dollars that they may force you to accept in exchange?